Let's dive into those January retail sales numbers now, blowing past expectations, coming in at 3% on the month. Joining us now to discuss retail sales and the markets is eToro global market strategist Ben Laidler. Ben, good to see you here. Big report. Do you think this report feeds this growing narrative on Wall Street amongst economists of a no-landing scenario where we don't see the economy slowing down and inflation still remains high?
I think it does, right? Never bet against the U.S. consumer. But I think, the rally we've been seeing is very fundamentally driven. And the resilience of the U.S. consumer, is part of that. This seventh down month for inflation, this, maybe 2 hikes away from the top of the Fed cycle. I think that all builds that narrative of just less inflation and interest rate shock that drove markets down last year. But also combine that with the rest of the world, right? We have the reopening of the second biggest economy in the world with 80% lower natural gas prices, taking an imminent European recession off the table. I mean, put all that together and, there's plenty of technical reasons why this market's rallying, but it's really all about the less bad fundamentals.
Does anything within this report change the Fed's calculus?
So we're all looking at the same things, right? Wages are sticky, services is sticky. That's absolutely a sort of concern here, and we're all right to watch it. But if we're talking about inflation, there's just supply chains disruption has collapsed. Housing lead indicators, have collapsed. Goods prices is coming down really hard. I mean, labor and services is always the lagging indicator. And that shouldn't surprise us. We're going to have to wait for this. This is, it's a marathon, not a sprint to get inflation down. But I don't think there's too much here that takes, that undermines that declining inflation story. And it definitely takes that recession story off the table for a while.
I want to pick up on the last point, Ben. It's Julie here, because that seems to really be receding. The recession talk seems to be receding, that is, over the past month or so, call it. Do you think that, I mean, what would say to you the recession's absolutely not happening, or we're out of the woods, or what's like an all clear sign for you?
We're definitely seeing us a re-acceleration right now. And I think part of that is, let's not forget what happens when inflation falls. I mean, consumer purchasing power sort of begins to come back. And I think that's part of what we're seeing right now, maybe what we have to look forward to for the rest of the year. But, let's not get complacent. We're still in a race between the lagged impact of these, this dramatic hike in interest rates and us, potentially being able to sort of dodge that recession. And these strong retail sales numbers, the resilient consumer, the resilience of corporate America, at an absolute minimum, that just buys us a little bit more time to sort of thread that arrow. Which I'm a bull, so I think we're going to. There are plenty of risks out there, but again, I do think the fundamentals have absolutely improved this year, and we're pushing on an open door because I also think the technicals are very, very supportive as well.
Ben, a couple weeks ago, we got a really blowout jobs report, now a blowout retail sales report, notably in department stores. I mean, those gains are huge. Does it raise the case now or the situation that the Fed may have to go more than 25 basis points on rate hikes at its next meeting?
Very possibly. I mean, maybe not at the next meeting, but, I think they're on par for 25 at the next meeting. And, maybe we put 25 on the table for the meeting after that. But, take a step back, big picture, we're getting fairly close to the top of this cycle. I think the bigger question is, how long do they keep rates high? And again, this is where the sort of race comes in. I think they're gonna pause, they're gonna wait. They're data dependent. They're going to be watching, these services, these labor numbers, the sticky bits of inflation as much as the rest of us. But I think it's more about the length of a pause rather than, do we have a dramatically much higher to go here.
Obviously, we're talking pretty short term here, short to medium term. And you recently tweeted something that caught our attention that has to do with how long people are now holding stocks. Can you talk us through that and what the implications are for their investments?
Well, I would say there's two implications. So, if you look back historically, a few decades ago, the average holding period for stocks in the US was 5 years. Last year, it was 10 months. And there's a lot of reasons for that, the rise of high frequency trading, et cetera, et cetera. But absolutely, investment holding periods have got shorter. And I don't think that's good news. I mean, as Warren Buffett likes to say, it's, time in the market rather than timing the market. The more you're churning the portfolio, the more the more that's costing you, the more taxes you're liable for, et cetera, et cetera. But, bring it back to the here and now, I think one of the big sort of technical supports for this market, and we saw it yesterday, right? We didn't get a great inflation number and the market ended the day flat, is that a lot of people have been caught out of this market. Maybe by overtrading, maybe by those short holding periods, they've been caught out of the market. Cash positions are very high. We've had fund outflows, this year. And I think that's very bullish. Aside from the fundamentals, this is going to work out one of two ways. Either the fundamentals are going to keep improving and that money is going to be forced, into the market out of this pain trade, or we're going to have that inevitable pullback. And even then, I think you're going to see, those high cash positions, get trimmed down.
While we've got you, Ben, we do know that retail investors, you believe that they're kind of a key unsung market support more now than ever. Some retail investors have also piled into mimetic names. If you are a retail investor that's reading this retail sales data this morning, should you be more or less appetite or apt to get into some of those mimetic trades at this point, knowing that there is this at least 1 month strength that you've seen in some of the department stores, some of the discretionary categories even that consumers had kind of shied away from?
So I think retail investors have been a big anchor for this market. So U.S. household allocations to equities are about 50% higher than they have been, historically. And a lot of people are worried about that. It was the first bear market for a lot of these investors, but they didn't sell. They were actually been buying the dip 2-to-1 versus people that have been selling. They think about this market in years or decades rather than days. So I think they've been a massive anchor, and not the only one. I mean, I would just quick shout out to corporates and share buybacks. We had over $100 billion of share buybacks announced in January. This is even with the new 1% share buyback. Tax, that's 3 times higher in terms of announcements than we've seen in sort of previous Januaries. And remember, this is the biggest single buyer of U.S. equities. So again, I think there's a number of sort of unsung supports for this market, whether it's retail investors, whether it's stock buybacks, before we even talk about the improving fundamentals.
eToro global market strategist Ben Laidler joining us this morning. Thanks so much for the time. We appreciate it.